Good afternoon, everyone. Welcome to this webinar on the impact of ESG on insurers' future strategy and operating model. My name is Peter Manchester. I have the pleasure of leading EY's insurance business in EMEA, and then will be the moderator for the panel today. Before we get into the session itself, I wanted to provide perhaps a bit of context for our discussion today. I think we're all very clear that as we enter 2022 against the backdrop of COP26 and various commitments made on decarbonisation, net zero, it's clear that ESG principles have really risen to the top of the agenda for insurers. And whilst organisations are obviously at different stages in their development, it's perhaps become increasingly important for them to really define, refine, and communicate a very persuasive and actionable ESG plan, whether to investors, regulators, policyholders, shareholders, etc. And perhaps as importantly, as an industry, what we're seeing is the ability of the sector to contribute perhaps to the reshaping of the financial system, whether that's through mobilising capital for decarbonisation, helping facilitate the transition of carbon-intensive industries, and really helping to drive credible adaptation and transition strategies for our clients. Now, whilst the E in ESG has received perhaps a huge amount of press and attention over the last 6 months, it's also clear that the other aspects of social stability and transformation, whether that's gender, race, wealth equality, remain essential and foundational to an organisation's perspective, perhaps around purpose and future value. So really the focus of our discussion today will be on three things. Firstly, really on the what and the how, I guess, of ESG. So, what are the key aspects that insurers need to address to create executable and informed ESG strategies? And what does that mean for operating models, for products, for participation, etc.? Then how should this be embedded across the organisation to make sure that this is communicated to all the relevant stakeholders and bought into by the various sort of groupings? And then finally, how can insurers perhaps most immediately deal with the increasing plethora of disclosures, measures, metrics and reporting that we're starting to see emerge as ESG becomes, I guess, more embedded in the sector? Now, in addressing these questions and topics, I'm delighted to be joined by a fantastic senior and experienced panel drawn from our industry. So let me introduce them very briefly. So Dr. Ruth Middleton, Chief Risk Officer at AIG Life UK and EMEA Life and Retirement. Eugenie Molyneux, who's the Chief Risk Officer for Commercial Insurance at the Zurich Insurance Group. Katie Lennon, who's Head of ESG UK and Lloyd's market at AXA XL. And finally, Robin Arfi, who's the Chief Risk Officer at Beazley. So hopefully we can have a fantastic conversation around what I believe is one of the most important topics in the insurance sector over the next 2 or 3 years. So let's sort of start off. Maybe Ruth, I could turn to you in the first instance. So, 2021, as we said, sort of showed a real step change in the market and regulatory context for insurers around ESG. What's your sense in terms of the next 12 months? What's going to be really critical for insurers to get right? And perhaps, does COVID influence the pace at which organisations can really sort of deliver against some of these commitments?
Thanks, Peter. Yes, I mean, as you've raised already, there's been a lot on the regulatory agenda across the whole of ESG. We've seen the climate risk agenda enforced with a lot of regulation coming from the PRA and FCA. We have seen from the PRA's recent Dear CEO letter, which has a focus on diversity. There's the continued focus there for the S. And we've been all sort of like working towards the operational resilience agenda, which is also giving us that focus on the G. I mean, what we've been looking to do is to, through 2021, is to understand what's important from an external and internal lens. Have run a materiality questionnaire because the ESG agenda is incredibly wide, and it's where do we get that stakeholder engagement? How can we understand what our external and internal stakeholders are looking to define as what is material for us as an organization? Where should be those areas of focus? So we have that materiality questionnaire, we have those results, and it's then taking the outputs of that, and it's going to be a continuing evolution for us for 2022. It's a circular process. So we've got the definition of what's material, and it's defining appropriate metrics around those, and then considering the standardizing of the data collection around that, how we can give people assurance around the data and the metrics, and then just going around to then feed that back into process improvements and then continuing stakeholder engagement. So it's that continuing process of embedding and involving the framework, I think, that and understanding the evolving and continuing focuses for stakeholders, both internal and external. And I think it's just trying to embed and evolve that. Is going to be a continued focus for the next 12 months. And doing this also, not just because we're getting the regulatory agenda to do that. I know there's a lot of regulation, as you said, that's come out on all of this, but it's what is actually the focus, what's the fit for the vision and strategy of the business. So being led by the vision and strategy for the business, not being led by addressing regulation. So I think that's one sort of area. You also raised the interesting question here about COVID and how that has impacted. I think COVID has opened up for us new lenses to the ESG agenda. Now, if I can sort of expand on some of those, we have had now like more of the introduction of the hybrid working model. So I think we have considerations for that as to what that means for staff engagement, well-being, and staff wellness, sort of focusing that sort of on the sort of like the S element. We also have what it means for products. So, for example, we've seen increases in financial hardship. So we've seen insurers introducing ways to respond to this through premium reductions, premium holidays, to be able to address that social element with our products. Also introduction of value-added services. So AIG Life has Smart Health that it has with a number of its products, which means that people have access to an app which helps them with mental and physical well-being, as well as access to a GP, which through the COVID environment has been a big benefit also. But going back also to that, to the E element with the hybrid working model, I mean, I think this is something that as insurers are looking to share carbon footprint metrics, this introduces interesting questions for us to consider with regard to carbon emissions and how we consider that with hybrid working, because we're still sort of, we have the benefit that people aren't commuting to the office. And so that can cut down some of the emissions associated there. But then equally, people are at home, we're warming their houses, they have their lighting on. And how does that balance when you have an office that's heated and lit anyway? So I think we're going to see evolution on what that means, not just for the immediate carbon emissions that people are considering, but also for like the scope 2, scope 3 emissions as well, and how these new working models can sort of link in with that. So it's just a number of new lenses that are opening up to us as we're sort of like coming out of that, the changes COVID has.
Yeah, no, I agree with you absolutely. And I was interested in, I think it was a recent interview with Mario Greco actually from Zurich, who was asked a similar question. He said, well, the interesting thing is that COVID made us transition our operating and business models far faster than we would normally have done. And therefore, it's sort of given us a practice run in some ways in terms of how we should do this now. And then secondly, it also sort of proved that we can't do it in isolation. And that we have to respond as a sort of sector and an industry. So yeah, maybe, in some ways, I wouldn't say blessing, but in some ways, COVID has been a sort of interesting foretaste of how quickly organizations perhaps can shift their operating models and their business mixes.
Mm.
I don't know whether that resonates, Eugenie, with you from
your
perspective.
It does very much so. But I think so first of all, what it tells us is when the time comes from adaptation, if we're put under pressure, we can actually do it relatively quickly. So I have faith in human beings' ability to adapt when the time comes. Unfortunately, what it also shows us is we wait for that moment to happen. Actually in the lead up to COVID, there were a number of warnings that we should expect to see a global pandemic. And in fact, I think even the US government ran simulation exercises and then sort of did nothing with the findings. So I think what it tells us is two things. Yes, it tells us we can adapt when we need to, but it also tells us that perhaps we shouldn't wait, that perhaps we should be addressing some of the topics and climate change would be the obvious example, biodiversity loss as well, would be some examples where we can probably get out in front of it rather than react when the moment comes or in the face of a triggering event.
Maybe just on that, I guess link back to the sort of strategy point, how important do you think it is that organizations set a sort of very bold ambition? I know different organizations have talked about 2050 or 2030 or 2025. Is that important in coalescing, I guess, the organization around a clear purpose and a clear strategy on ESG?
I think it is. I think it is important to have a bold ambition. Equally, it can't be so bold that you can't get your organization behind it. So it needs to be within that realm of possibility. So bold, but possible. And equally, what will happen, I think, over time is that at this stage, we as insurers, but even many of our customers are really talking about transition plans. Over time, what will happen is that will transition itself. It will change itself. People will judge us more from delivery rather than the boldness of the plan that we have over time. Now, we're not there yet. You asked Ruth what you thought about the next 12 months. I don't even think that will necessarily come in the next 12 months. But I think give it 5 years and people expect to see some delivery on those plans. So yes, I think it's important that it's bold. Equally, it's important it's possible. Otherwise, you won't have people behind it. And that could be your shareholders. It could be your employees. And lastly, it's going to be most important that we deliver on it.
And maybe just I absolutely agree with that. And I guess just a last point on that, how important, I think we're all very good as organizations on communicating internally about our ambitions and goals and our strategies, perhaps less good at communicating externally. How important do you think it is going to be to A, arrive at those clear and measurable commitments, and B, but make sure they're aligned with external stakeholders?
So firstly, I'd say I think it's important that we can define commitments that are measurable externally, but we shouldn't underestimate how difficult it's going to be to come up with those measures. And the fact that over time, as, shall we say, the quality of the inputs gets better or our learning gets better, probably the quality of those metrics will improve and they may even change over time. So I think an important piece of the communication exercise is twofold. One, it is a transition. Talking about climate change now, I'm talking, right? It is a transition. So it's not an on and off switch. Yeah. So it's very important that people realize, no, what action we might take today could even be different tomorrow. So the extent of the action will increase over time, number one. Number two, the metrics that we might have available to us today and the calculations we have today are probably, because they're more difficult and over time the data will improve, they're probably less reliable today, and then again over time they'll improve and become more reliable and more robust. But it's important that we make our key stakeholders understand that A, it's a transition and there's a balance to be had as we go on that transition journey, and B, along with the reporting, it's not that we can flip a switch and it's automatically we've got every number that we need for this journey.
Yeah, no, I absolutely agree with that. And I think it's an interesting discussions I've had with clients around, are we are we measuring the right things? Because we can look at P&Ls, we can look at core operating ratios, we can look at margin, but actually maybe it's time to start looking at different measures and metrics.
Well, if you look at something like, I'm in the commercial insurance, we're covering the commercial insurance division. In that division, we're very much reliant on what our customers' transition journeys are for something like climate change and their reporting for us to assess potentially what the carbon footprint of our underwriting is.
Yeah, no, I agree. And maybe just taking the point you made and perhaps passing to Rob, just in terms of, the next 12 months, maybe about, creating the plans for transition and adaptation. Sort of committing to change is one thing, actually doing it is something else. And driving change in the organization is always more difficult than we first think. Any thoughts, Rob, in terms of, from your experience, what you see as critical to success in sort of implementing these changes and executing them in a consistent way within the organization?
Yeah, sure. I'll speak to that, Peter. But just before, thought I'd make a comment on your question to Eugenie about communication stakeholders. One of the challenges, I think, with the conversation we're having today is the combination of the E and the S and the G. Because depending on which group of stakeholders you're speaking with, you very quickly coalesce around one of those three.
Yep.
And because I guess the G, you could argue has always been around, the S in particular around inclusion and diversity has had a fair amount of airtime in recent years. And so it's the E that's new, and it's the E that we all know less about, but it's the one that clearly is the most urgent for all of our existence. And therefore all conversations tend to be around that. So I have questions in my head sometimes when on panels like this and when speaking with people about the wisdom of combining all three. Anyway, in terms of communicating with stakeholders, I think what's critical is understanding who the stakeholders are for each organization and which element we're talking about around the E, the S and the G. So I just wanted to add that. Clearly, there's a lot more to be said around that, but I just think if anyone's thinking about communication, really segregating those three and understanding which groups of stakeholders we're talking about is key, because what we've learned recently is that by going long on one set of messages, you may well be upsetting a different stakeholder group, and that's why the conversation around E has now moved to transition rather than what an insurer may or may not cover. Because actually, if you make really bold statements about what you will or won't cover, you're doing a disservice to a particular customer group that actually needs your services during the transition. And so to your questions around implementation and plans, I think this is something that is consistent across all three areas of ESG. And I think for me, they all come to cultural change. To make those changes embed behavioral change, cultural change, which therefore always comes from the top. So I have seen in our organization in Beazley, I think it's fair for me to be proud of our governance and our culture and how we operate. And that has really stood us in good stead. When we started our inclusion and diversity journey, it meant we moved quite quickly in embedding expectations and in people at various levels of the organization understanding the roles they had to play. And then when they look to the people that they're aspiring to be, or the people that they take messages about what the organization's priorities are, they could see those people were also doing the right things, and therefore they all followed suit. And it's a similar approach really that we're applying when we come to the E. And to support all of that, you need quite clear governance. So from our board through to our underwriters, various executive and board committees, we have embedded oversight of climate change, both from what we call from a responsibility perspective, so our impact and our facilitation of transition, but also the risk to us as an organization. So from both sides of the coin, we have very clear governance, very clear accountability. And then you would have heard potentially about us launching a new syndicate, 4321. So we do very specific things that means that there are tangible things that we're doing that hook onto what our stakeholders internally and externally hear us say. So I think in summary, good governance, understanding that some of this is behavior and cultural change, and therefore the most senior leaders of the organization need to say the right things, but also need to do the right things so that everybody in the organization can understand that it's a priority and what they need to do to make it happen.
Yeah, no, I agree. And just going back to your initial point, I guess, around the sort of conflation of the E and the S and the G. I was at a seminar recently with a number of CEOs, and one of the questions that was asked was, what does purpose mean for an insurer? And we got sort of, out of the 5 CEOs, we got 5 different answers, because it really does depend on, you know, your market, your business, your focus. So it's definitely not a one-size-fits-all answer. It will be different depending on the nature of the insurer, where they play, how they play, etc. So I absolutely agree with that. Thanks, Rob. So maybe pivoting slightly to, I guess, a focus around how ESG is going to impact the sort of overall business model, whether that's products or participation. Maybe, Katie, just getting your thoughts from perhaps an underwriting perspective on how ESG considerations and principles are starting to inform medium-term plans and thoughts around either policies or participation. Any observations you have on that?
Yeah, of course. Thanks, Peter. So for me, when we formulated our ESG strategy for the UK Lloyd's business of AXA XL, we've considered it in 2 parts. So we've thought about our own business operations, which covers everything internally. That's to do with our scope 1 and 2, so our carbon footprint and the way that we manage our talent and our workforce and our internal governance. And then the second part of that is how we're servicing our clients, how we're servicing the market, and what it is that we're putting out there. So for me, I think there's 3 really big drivers of what product development are going to look like over the next kind of maybe 12 to 36 months. So drivers of those being, I think that the first one we've already touched on, we've mentioned earlier, like the role of the regulator. So not a massive driver of major product innovation, but when I think about product innovation, I think about it in 2 ways. So we've got innovation, which is brand new, shiny stuff, and then product iteration. So how do we start changing our wordings and start amending our services and our products to help people make better decisions, to help our customers make better decisions. And from a regulatory perspective, we're maybe seeing a little bit more pressure there for iteration. So for example, some of the new right to repair legislation that's come out, particularly in Europe, and also changes to the IDD requirements on the topic of sustainability as well. So we will start seeing, I think, increased regulatory pressure around the world. Incredibly important for the specialty and P&C market in London with the number of jurisdictions that we serve. The second big driver is of course going to be our customers. So our customers are on their own ESG journeys. And I do really want to stress that ESG is so much bigger than climate change. The E in ESG is so much bigger than climate change. So we really need to make sure that we're broadening out that conversation. But as our customers go on their own ESG journeys and start making amendments to their business operations or their supply chain, so whether that's in response to the energy transition or incorporating better human rights policies and making amendments to their supply chains for those kinds of reasons, we want to make sure that from a product iteration perspective, they're not actually going to experience any changes in the coverage that they have. So I think we experienced during COVID that because we had clients, as an example, changing from creating perfume to creating hand sanitizer, or from building hoovers to building ventilators, we've had some really great examples of how the insurance industry has responded to cover new operations and those kinds of amendments, but it's about having that two-way risk conversation, making sure that the clients truly understand that they've really changed their risk profile in doing some of these things, using new chemicals, using new technologies, and making sure that there aren't gaps in coverage that they're going to experience. I think that's incredibly important. Then, of course, there's the new and shiny stuff, which is maybe a little bit more exciting, but it's also the longer burner. So it isn't necessarily, we're not going to have all of the 2050 energy solutions by 2023. So there's a huge amount of work to be done there. And it is incredibly exciting. So new technologies are going to demand brand new products. And again, that two-way conversation, getting insurance companies engaged very, very early in that conversation, not just so that we can offer customers a risk transfer product, but to be part of that whole risk consulting journey. So we are the risk experts. So actually getting us involved very early in that conversation helps de-risk very early on. And I think that that's a really important role that the industry has to play from an ESG perspective, is that we can help de-risk from an early stage and actually accelerate things like the energy transition and the human rights journey, right? Like we can de-risk from a very early stage. So that's how I think that the customer needs are really going to help drive that need for new products and new services. And then, of course, there's the conversation around purpose. So if you have a strong purpose and you are rallying all of your colleagues and your employees behind that purpose, you naturally find that you're going to organize yourself to deliver on those things. So one of the great things that we've been doing over the past couple of months is redesigning our kind of like innovation resourcing model. And that's really exciting because actually we're making sure that we're putting our time and our effort and our resources behind creating solutions from an ESG perspective. And actually, I think we'll increasingly see organizations do this over the next maybe 12 to 36 months. Of course, the big piece behind that is making sure that you've got a clear purpose, you are communicating it well, and you can rally your people behind it.
Yeah, I think, as I said before, I think purpose it has to align with long-term value and purpose. Just a further question though, we live in an intermediated market, particularly on the commercial side, either with brokers or other distributor relationships. How, your perspective, how do you envision working with either brokers or other distribution partners in helping define that sort of pragmatic approach that you laid out there, Katie?
Yeah, brokers are incredibly important to this conversation. They're the people that really help draw out what it is from a risk perspective and a business perspective, what's changing from within our clients. So they're absolutely fundamental to this journey. And of course, many of them offer their own risk consulting services, which customers are going to start demanding different things of their brokers as well. So that's actually something that's going to be a shared challenge for intermediaries and for carriers. We need to make sure that we're all on the same page. There's a very big industry education piece here which is needed, and that's because we all are at different stages of this journey. So making sure that actually we're all coming to the table in a very informed way and can have that discussion about risk on a very broad basis is going to be really important.
I agree, thank you. And Eugenie, just picking up on I mean, Katie talks about shiny things, maybe, and we all get excited about shiny things. So any thoughts from you as to this, whether ESG provides an accelerator for a different type of product set or a different type of proposition? People talk a lot about the ecosystems that surround insurance and moving more towards more of a customer-centric model. But and I'm very conscious that Zurich perhaps issued the first net zero unit-linked product, which around carbon neutrality. So any thoughts from you on that?
Yeah, and it's not, I think, very dissimilar to what Katie's just talked about. Obviously, this provides all insurers with an opportunity to either tweak existing products or develop new products. So with the new technologies, we all have to develop entirely new products. I would argue this isn't just an ESG topic. Actually, it's just the changing nature of the risks that we face and the different needs of our customers. So Katie also mentioned services, and that's a big topic for us as well, because if you come to something like the pandemic is a good example of something which the customer will face an impact from, but doesn't necessarily have coverage for. Yeah, but they still require protection of some sort, whether that's through their own resilience. So these are the kinds of services where we can help the customer And what's particularly valuable in an insurer helping a customer in this particular journey is typically we share the risk with our customers. Typically we're on the hook, they're on the hook, at least for a piece each. It's not typically all of the insurer or all of the customer. It's typically a shared risk. So in this, we can actually help each other. So I do see services in particular being valuable to our customers going forward. And I don't think it's just in the area of ESG. So something like cyber is coming to mind here. Yeah. The other, I did just as an aside, I did see in the Q&A there was a question about commercial insurance and when would we see ESG as a topic in commercial insurance. Coming back to what both Katie and Rob said, this isn't new for us actually. The E is newer, but the S and G are relatively not newer for us. We at Zurich have already had, prior to the coal position, for example, positions on human rights or banned weapons or dam construction. So this isn't a new topic for insurers. What's probably changing with the dynamic is the potential impact of the E and the climate change or the biodiversity loss piece of the E to our customers, hence driving the change in products and the change in and the need for services.
Maybe one of the, just building on that, Eugenie, one of the questions that have just come through, probably one of the more difficult questions is, how do insurers balance the problems with insuring corporates with poor environmental records versus the social impact of not insuring them at all? So, which is a very pertinent question currently.
Look, this is a very difficult topic. And somebody said it earlier on, it might have even been yourself, it's very difficult to take a hard and fast or black and white position, because doing so you can create other consequences, unintended consequences. So for example, if you take a very black and white position on an E topic, exactly as Rob said, you may actually fall foul of an S topic, for example. So black and white positions are typically very difficult. While they make our lives easier in terms of we can say, yes, we can do this, or no, we can't do that, it's very difficult. And let me give you a tangible example. We have obviously a number of customers who are going on a climate change transition journey themselves. So the question is, if we cut them off because we say their plans aren't good enough, because maybe somebody else has a better plan that's out there, then how do you judge a company that has a much better plan but fails to deliver on it versus a company that has, shall we say, a more modest plan but actually delivers on it, particularly when you're only at the planning stage? So it's very hard to take a hard line on these topics. Typically, you have to look at other factors, like what's the company's response.
Yeah, no, I agree with that.
Well, if I could add to that, Peter, I mean, I think where we are today, this is the main issue that organizations are battling with. And we've seen in the marketplace, some big insurers have made statements that they've had to retract from. So I think one way that you could address this is by each organization being very clear what its own position is, and then aligning its client base with what its position is. Because it's easier to answer the question for yourself as an organization: what do we want to do? What's our transition appetite? And then I think if that's your kind of value or risk appetite for a transition time frame, etc., then you should be consistent in applying that to your customer base. I think the other thing is the function of time. So there is obviously a lot of pressure from particular groups who would like to organizations and insurers to take the black and white view that Eugenie just described. But I think if one would take the time to consider, for example, in developing countries, what that could mean to those economies on the S side, then it helps to bring about that balance. But over time, that will change. So how we feel today about where organizations are will be very different to how we feel in 5 to 10 years' time. So I think, again, in trying to find that balance, taking that into account and using that in articulating where an organization's position is could be helpful.
Yeah, no, I agree. I obviously agree with that. difficult conversations around those areas. So let's perhaps I think we said earlier that there's a huge focus on E, and a lot of the discussion we've had for the last half an hour has been on the E. If we sort of pivot to the S for a minute, so maybe Ruth, just getting your thoughts around, how do you see, in line with the conversation we just had, how do you see insurers really addressing their sort of social license to operate?
I was going to say, if we're talking about it in terms of where we've just been mentioning about the wider accelerator for product types, partnerships, ecosystems, etc. And I think with the S, and I've already mentioned some of the the new products that we have, so like value-added services with products that I think we'll see those evolving. But I think in terms of partnerships that we will see in terms of third parties, I think we're going to see the relationship with third parties evolving, and that's when we're considering who we partner with, and when we're considering, third parties are considering working with us as insurers. I think we're going to see that due diligence, for example, is going to increasingly include a wider scope of information on the ESG elements. So we've mentioned a lot on the E, but I mean, we're going to sort of be covering things there. For example, on the S, you mentioned staff training and engagement, the diversity information also. I think will be increasingly captured, and people will have views as to what they're looking for with the third parties that they engage with as well on that. So I think I think we've all mentioned that there's going to be a big challenge with all of this, is in ultimately setting what those targets are, what our stakeholders externally are looking for, what internally, and having the targets that are robust, measurable, quantifiable, and moreover backed by data that people can accept and can influence on these areas. I mean, the S has got a lot there with regard to how companies manage relationships with their employees, suppliers, customers, also the community in which they operate. So it's how an insurer can evolve to publish more about the gender and diversity, gender pay gaps, for example, customer satisfaction, net promotion scores, and how we can be more transparent on some of these elements as well, and publish more on this. I think those are also elements on the S that we'll continue to see evolving as well. But as you have mentioned, it's just that the focus at the moment, I think, has been considerably on the E element, as that's as Robert said, the new and shiny one that people are working with, and the S has been around. We've been discussing a lot on that more recently, and we're starting to see the S and the G evolving and overlapping as well. So, for example, with the developments we're seeing on regulations around board diversity, so we're seeing the diversity on the boards, which you might expect that to be the governance overlapping with the S as well. So I don't think that, I think we're starting to see the E, the S, and the G overlapping, as well as being, individual elements, each and of their own.
Maybe just picking up one of those points you make, Ruth. So looking at maybe diversity remains a key issue, and I was just looking at the insurers in the Fortune 500, about 11% have female CEOs. So there's obviously progress being made, but from your perspective, what really needs to be doubled down to accelerate progress? Whether it's sort of talent, how do you attract the right talent? Is it education? Any thoughts you have on that?
I think it's. I mean, if we're talking about it within the insurance industry, I think it's understanding why people would want to, or how we can actually go out and attract talent to the insurance industry and be beacons, if you like, as to why it is a great career and an interesting career to have. And I think that's going out to the whole community out there to attract the talent and to encourage them to join insurance, and be completely open about that, understanding why people might not consider it to be an interesting career to go into. And I know it does have like connotations of being a bit, even if you think about it, some people can think it can be a not as exciting to go into as some other careers, especially, for example, people don't necessarily understand risk management. So I think it's us being able to go out there and be able to sort of stand up and attract that talent as widely as possible, and to, as we're attracting that talent, to consider a talent across all areas of the community. So not to have views as to where we might think that talent might come from, and where we might think that we wouldn't necessarily find such fantastic talent, because it's sometimes our innate biases that can blinker us to getting the best people for the job.
Yeah, I agree. I mean, there's a very scary statistic, isn't there, that about 30% of all of the sort of technical insurance staff in the UK, whether it's claims or underwriting, are due to retire by about 2025. There's a big gap in terms of talent and capability, and how does that get replaced?
I mean, I think one of the ones is also where we consider, for example, people tend to think that people in risk management are actuaries, and I think that I myself am not an actuary, so Rob too. So it's that, for example, it's even knocking down some of those traditional sort of like considerations, because people from different backgrounds have different ways of approaching problems, different ways of solving problems, different lenses they can bring. So it's not just actuary versus non-actuary. It's what culture did you grow up in? What schools did you go to? Having that complete diversity of absolutely a complete different melting pot just gives so many different lenses on how we can bring people together, solve problems, and ultimately just grow together with learning from other people's backgrounds, other people's ideas, other people's lenses, and that can only be a good thing.
Peter, could I make a comment on your question and maybe speak to one of the questions that I can just see in the chat?
Of course.
I agree completely with everything that Ruth has said, and I'd make an observation. I'll try not to get on a soapbox when talking about inclusion and diversity, because it excites me and frustrates me in equal measure. We have been working on inclusion and diversity in the insurance industry for decades. And I would argue we really haven't made any progress at all. We've made a little bit of progress on gender, but it's nowhere near where we should be, really. So it's actually quite nice to be on a panel where you and I are outnumbered from a gender perspective, Peter, from what I'm assuming anyway, makes a difference in insurance. But one of the reasons that journey has been so long and so hard is because not everybody has been persuaded of the need for diversity and of the benefit of diversity. The difference between that and the E is everybody knows quite clearly, unless you're Trump, of the need to react quite quickly. And regulators have jumped on it really quite quickly also. If I take race diversity, well, we have a government in this country who don't even believe there's a problem. So we have a gender pay gap and a women in finance charter. We have nothing like that for race or for disability or sexual orientation or anything like that. So there are some different dynamics that are lacking in the S space that are only just starting to come to the fore. If you look at some of the commentary that we've seen from the regulators and how long we've been trying to fight for diversity versus how recently we've understood the risks around E and how quickly they've jumped onto that, there are some different dynamics. You asked the question, what more needs to be done? And I spoke to the first question you asked me of the importance of leadership. For me, fundamentally, if leaders in our respective organizations and our industry really believe that this is important, it will happen. That's how things tend to work in our industry. And to one of the questions that somebody's asked, it's around whether we think organizations with good ESG scores present a lower risk. Certainly in the new syndicate that we've created, that's one of our working assumptions, that we will offer through that syndicate more capacity to clients who have good ESG scores. Now, in doing that, we're placing a lot of faith in organizations like Sustainalytics, etc. But we do our due diligence to make sure we don't just take one data point, because if you believe, even if you just looked at the S, that organizations with a more diverse board are going to manage their risk better, and there's evidence that suggests they will be more profitable, for example, then it has to be true that if you extended that to those that have good governance, that have identified the risks around E to them and globally and are working well on those, then they're going to be better run businesses, and therefore we're willing to give them more capacity. So I think there's to the person that asked that question, that's certainly our working hypothesis.
Thanks, Rob. There's a lot of questions. I mean, at the start of this, we talked a lot about data and sort of proclivity of data requirements and disclosures, etc. A lot of questions in the chat around, what approaches and data points insurers are really going to focus on to measure ESG, and how do you deal with the sort of, I guess, yes, not completely formed view in terms of what disclosures and data requirements are going to take. So maybe Rob, just to kick off, maybe any thoughts you have around sort of how you manage that sort of data requirement as an insurer.
Well, that's the difficulty, isn't it? Not on G, but certainly on E and on S. If I start on S, one of the reasons for lack of progress is because we work in an industry where we work with data. We like to work with data. We like to work with metrics. So if you don't have the data, it's an easy get out for people to say, oh, we can't measure it, so we don't really know what to do, so therefore we won't do anything. We don't have that luxury because the regulators are making us move on the E, but that's the very reason why it's difficult to set meaningful goals right now. So I think we are certainly putting a lot of effort into enhancing our operations, our infrastructure, to be able to capture, but not just capture, but use data in the right way across both the E and the S. And I think it's in those spaces that we need much more collaboration across the industry. I don't think any one organization that I'm aware of is that much significantly better than the other. And I think this is where we need industry bodies to help us collaborate with each other. Eugenie talked about cyber earlier. I think about where we were 10 years ago in a wildly different space today. And that has taken a bit of collaboration, not actually just from within the industry, but with other stakeholders like governments, for example. Yeah. And I think we need to do the same to get to the level of data we need to help us tackle these risks.
Maybe just, yes, I agree. And so, I think the TCFD and ISSB is a good move forward in terms of getting a more sort of coordinated and consistent set of measures. I don't know, Ruth, whether you're sort of finding the same thing from an AIG perspective in terms of, how you look at those measures and what you're really focused on.
I think we're already publishing a number of things in different areas in terms of some of the measures already. So we have carbon metrics that are shared. We also have some of the, so that's the E. We also have information on the S. So we have claims data, net promoter scores. We've got gender pay gap. We have some on the G in terms of the financial stability. You have the SFCR, which has a lot there. Board composition and executive remuneration. There's quite a lot in TCFD reports as well. But I think that if we're looking about, so we already have a wealth of information. It's not necessarily in a one-stop shop. So it's across a number of different reports that are presented. So I think that if you're looking at it from an external perspective, that can be difficult when you're actually wanting to see what's the overall ESG agenda look like when it's split across a number of different reports, which goes back to another question that you'd posed earlier, Peter, about the number of different reports that are sort of requested here. I think other panelists have raised that sort of going forward, how we evolve this going forward is sort of a function of data and metrics that people can believe in and match with the purpose and strategy of the firm as to where we want to take things as well. So where can we get more targets around? I mean, I've mentioned we have the scope 1 carbon, we can have scopes 2 and 3 targets that we can start to think about. And then there are also something, if we're thinking about that's from the environmental, but if we're thinking wider from like the social element, are there more DE&I metrics that we can publish with regard to, as we've mentioned, there are a lot of different areas there that we can have across so like the disability metrics, as well as wider metrics, so not just gender pay gap, but can we consider if there are other elements there, for example, along sort of like diversity pay gap, other lenses on that? Are there things we can say about our supplier diversity as well? How we're attracting and developing talent on the social side, philanthropy and volunteering, how we're sourcing stuff responsibly. So it's how we are being sort of like if you like, a good person in sort of like in the environment that we're working in. How can we promote that? How can we develop that further? And then we've mentioned sort of like the product elements with regard to innovation of products, and are there potentials for sort of like sustainable solutions? So I think those are other elements that we could consider if we're looking at metrics and targets on the social side. And then we've mentioned sort of on the governance side, we've mentioned a number of things that insurers can do. On that, we've mentioned the board composition, and then there's just we already published, as I said, quite a bit with the SFCR that covers a lot of the risk management elements as well. So I think I think what's hard is sort of like pulling it all together necessarily into one place. Yeah. And saying discriminating all that insurers do, because we already do a lot, but we don't necessarily signpost everything we do as ESG, and pulling that all together into what does that mean holistically.
And I think it goes back to your point earlier about materiality and being able, because I guess the sector overall is probably got a journey to go on in terms of data architecture and data governance, and these additional requirements start to add into the pressure around that in terms of how you source, optimize, report and consume data. So I think a view in terms of what's going to be most important is essential. So I wholly agree with that. Maybe a last question from me before I look at some of the questions in the chat. But I have a number of chief risk officers on the panel. And I guess one of the dangers is that there's a series of obligations placed by the regulators from a prudential and conduct basis, and particularly around ESG. How do you make sure that responsibility for ESG doesn't just sit with the CRO in an organization, and that you make sure that the organization I guess the responsibility is embedded more across the organization than just with the risk function? So anyone would like to kick off on that one?
I think you get on the front foot and propose where you think the responsibility should be in the first line before somebody gives it to you. But this also aligns to the G. So if you've got really good governance and everybody understands whichever model you're using, whether you're using a 3 lines of defense, people should, if it's really embedded, the board, for example, should not tolerate you as a CRO trying to take first-hand responsibility, or anybody else trying to give it to you. Now, the only caveat that I'd give is, to my mind anyway, when new risks hit, it isn't unusual for an assurance function or for a CRO to just get in and get hands dirty and just help the organization figure out what to do. So, for example, we were part of the CBES and we were quite active, not just in overseeing, but actually just making sure the organization could do the right thing. But over time, I think you then need to be clear where you start to draw out and leave responsibility with the first line. So I think this is part and parcel of organizations having really effective governance, but equally not being afraid as a CRO to get more involved when it's new and everybody's running around trying to work out what to do, but don't get stuck in it, right? So you need to make sure that you walk away at the right time, be clear who has it in the first line, be clear which governance committee, both executive and board, is responsible for overseeing it, and know what your second line oversight looks like.
Rob, may I just ask a question of you? And it's who is your responsible SMF for climate in Beazley? Because where I am, AXA, sorry, Viva, AIG, it's the CEO who we have. Right.
So it's our CUO. So when it first came in, we had an interesting dialogue with the PRA actually, because we split it between the CUO and the CRO specifically for that basis, because we wanted the core responsibility first line to be with the CUO, but we wanted the CRO to be responsible for overseeing and reporting to the board to make sure that things were being done. And the PRA challenged that and said, well, we see most people only giving it to the CUO. And we explained and said, we get that, but we want, for now, some really explicit prime responsibility for the oversight and the reporting of the progress that's being made. But it's primarily with the CUO, but I do have a responsibility for reporting to the board whether we're doing all the things that we've said we're going to do.
So for AIG Life, we decided that there's so much that's strategic around this, that the overall strategy for the company sits with the CEO. So that's why the SMF responsibility sits with the CEO. And then as a CRO, I have responsibility for independent review, challenge, obviously elements like stress testing, and so on.
I'm conscious of time. We have a couple of minutes left. So maybe a question to all the panelists just to conclude. Maybe each of you could give your thoughts on. So if you looked out over the next 3 years, what one or two things do you really hope are in place within your respective organisations or in the sector as a whole to really sort of make a difference around ESG? So if there were 2 or 3 things you'd want to see happen over the next 2 or 3 years, what would they be? Maybe start with Katie.
Yeah, of course. Thanks, Peter. So for me, ideally in 3 years, I'm going to talk myself out of a job here, but my job shouldn't have to exist. So it should be that ESG topics are so embedded in what we do every day that you don't have to have somebody saying that you have to have an SMF function that is solely responsibility, that has sole responsibility for this. You don't have to have a head of ESG to help pull it all together, because the education and the embedded piece of purpose is so within your organization, it forms part of every conversation. So whether that's to do with your own business operations or the way that you service clients, it really needs to become part of our everyday. And that's definitely a journey that as insurance companies, I think we're all on. And a lot of it, I think Ruth mentioned it earlier, there's already so much that we're already doing. We're just not necessarily framing it as ESG. So that goes to Rob's point about improving the governance around ESG and whether that fits into your existing governance framework or whether you need a new governance framework specific to ESG. But I'm hoping that jobs like mine don't have to exist in several years' time.
Careful what you wish for, Katie.
Yeah.
Eugenie, maybe your thoughts?
Yeah, as the insurance industry, we have a role to play in terms of aiding the transition for climate change. What I would like to see over the next couple of years, however, is that in playing that role, that we don't see unintended consequences. And when I say that, I particularly mean with respect to, shall we say, low-income earners and the potential impacts to those parts of the community. And it won't necessarily be the insurers, but I mean our customers doing that. So as we aid the transition, I want us to have one eye on the S, and in particular, maybe focus a little bit more on the S and the G, bring it into balance with the E.
Yeah, thanks, Eugenie. Rob?
Katie, I think you'll still be doing your work in a couple of years' time.
Too ambitious, yeah.
but one thing that I hope doesn't happen is that the S and G gets drowned out by the E. I really hope that doesn't happen, because we really have not made anywhere near as much progress as we need on the S, for example. And then the one thing that I hope I described this appropriately, I think there are a range of assumptions around what kind of level of climate change to plan for. And I think it makes a fundamental difference to what the world decides to do, and then what we as an insurance industry are able to facilitate. And if there was any ability to kind of coalesce as a global economy around an assumption, whether it's 1.5% or whatever it may be, I think it would stop us all moving in different directions and globally move in a bit more of a consistent manner. So those are just a couple of thoughts.
I agree with that. Thanks, Rob. Ruth, just to conclude.
I think everyone's said pretty much everything. I mean, I agree it's going to be a continued journey, but ultimately I would like that insurers are seen as part of the solution, seen as a positive force for change here, and that we're sort of like good stewards of nature, and managing good relationships with, not only as managing ourselves with our governance, but with our sort of like our customers and our employees as well. So, all those elements, just fully embedding it, pretty much like Katie said, almost doing ourselves out of having to consider this as almost like a project. It's so embedded, it's so business as usual, and insurers are seen as a force of positive for that. Yeah,
no, I agree. Well, look, it's the top of the hour. We've reached our time. I'd like to thank the panelists for a great discussion, very involved and hugely interesting in terms of some of the issues that we've talked about and some of your observations. So thank you very much for that. And I hope everyone has a great rest of the day and rest of the week. So bye for now. Thank you very much.
Thank you, Peter, for your facilitation.
Thanks, Rob. Talk to you soon. Bye-bye.
Bye.